Welcome to Chartered Accountant's Pen. In today's lecture, we'll dive into IAS 29 financial reporting in hyperinflationary economies. This standard is extremely relevant for countries experiencing severe inflation, like Zimbabwe, Venezuela, and recently, Sudan and Argentina. Let's understand what hyperinflation means, why IAS 29 exists, and how companies should prepare their financial statements in such an environment. In hyperinflationary economies, the local currency loses value so quickly that historical cost financial statements become misleading. For example, if a company bought machinery for 1 million units of local currency in January, by December that same amount may not even buy office supplies. IAS 29 ensures financial information remains useful, comparable, and relevant for investors and stakeholders. IAS 29 applies when the functional currency of an entity is that of a hyperinflationary economy. But how do we decide if an economy is hyperinflationary? The standard doesn't give a strict definition, but it provides indicators. The most widely used benchmark is cumulative inflation rate exceeding 100% over 3 years. Other signs include general population preferring stable foreign currencies, prices linked to price indexes, not currency, interest rates, wages, and prices adjusted daily for inflation. When IAS 29 applies, companies restate their financial statements using a general price index to reflect the purchasing power at the reporting date. Let's break it down. Statement of financial position. Non-monetary items like property, plant, equipment, and equity are restated using the general price index. Monetary items like cash, receivables, and payables are not restated because they are already expressed in current terms. Statement of profit or loss. Income and expenses are restated to reflect current purchasing power. Gain or loss on the net monetary position is recognized in profit or loss. Comparatives. All comparative figures from prior periods are also restated using the closing index. Disclosure requirements. Entities must disclose the fact they are reporting under IAS 29, the identity of the price index used, and the movement in that index during the reporting period. Let's take a simple example. A company buys equipment in 2022 for 100,000 local currency. Inflation index at purchase equals 100. Inflation index at reporting date in 2024 equals 400. To restate under IAS 29, restated value equals 100,000 times 400 divided by 100 equals 400,000. This ensures that the equipment's value reflects current purchasing power instead of outdated historical cost. Applying IAS 29 is not easy. Companies face challenges such as lack of reliable price indices in unstable economies, systems and software not designed for frequent restatements, difficulty in explaining restated results to shareholders and regulators, complexity in consolidating subsidiaries across hyperinflationary and non-hyperinflationary countries. Recently, entities in Argentina, Sudan, and Turkey have been required to apply IAS 29 due to hyperinflationary conditions. For instance, Sudatel Telecom in Sudan had to assess hyperinflationary reporting, but disclosed challenges due to the absence of reliable consumer price index data. This highlights the practical issues entities face when applying this standard. To summarize, IAS 29 ensures financial statements remain useful in hyperinflationary economies. It requires restating non-monetary items and equity using a price index. A gain or loss on the net monetary position is recognized in profit or loss. The biggest challenge is the availability and reliability of inflation data. Thank you for watching Chartered Accountant's Pen. If you found this lecture useful, please like, subscribe, and press the bell icon to stay updated with more accounting and auditing insights.